And welcome to Class 35 of 50. This week is Anti-Selection, which we have a subtitle, Radical Transparency. Now, each week we try to describe the top five most important things, and this week is quite difficult because it's such a broad subject, but let's do our best. What do consumers need to know about anti-selection that will help them make an informed decision about life insurance? My favorite quote comes from Bill Strain's 93 paper, which he submitted to the Canadian Tax Foundation, where he wrote in his paper on innovative life insurance. He writes at the end of 55 pages, the results reflect not so much the quality of the tool as the skill of the artisan. Today, we're exploring one of the many sweeteners that can improve client financial results when allocating resources to life insurance. The life insurance wrapper tells us that clients aren't just buying insurance, they're investing inside an insurance wrapper, and that wrapper changes virtually every traditional investing rule. We're going through a transition in how product expertise is shared, and advisors now handle product design and contract selection responsibilities without comprehensive technical education. Bill Strain predicted back in 93 that technology would provide modeling tools. We have that technology, but limited industry-wide technical education for optimization across all products, it doesn't exist. I had a client who paid $116,000 over 31 years for $1 million of life insurance with Manulife. Manulife offered him recently $270,000 cash surrender. He has zero cash. They said, we will give you $270,000 to surrender your policy. Why did they do that? It's because Manulife would rather pay $270,000 now than risk $1 million later. Anti-selection occurs when your client knows their circumstances better than the insurance company knows their circumstances. Clients have specific information about their health trajectory, financial intentions, longevity expectations. Insurance companies use population averages. The expertise that they have helps clients use this information asymmetry for better returns. This is why we stay in touch. Policies need management for many years. Health changes over time. Financial circumstances evolve. Timing advantages appear. You need monitoring systems, annual health reviews, conversion window tracking, family situation updates. Anti-selection opportunities emerge over time. Buy term when healthy, convert when health deteriorates. That's the term conversion option. That's the most powerful anti-selection tool in life insurance today. Conversion is contractually guaranteed. Companies cannot decline or reprice based on health deterioration. An example, a client diagnosed with serious condition converted 500,000 term to permanent without medical questions. This is pure anti-selection advantage. And the conversion rights, they're unbreakable. Conversion periods are contractually guaranteed. Provincial regulations protect these rights. Companies factor this into term pricing. They know some will convert once sick, but individuals still benefit enormously by knowing their own circumstances. Historical precedent shows courts consistently uphold conversion rights. And is it fair? Is it fair to use anti-selection to improve the client's results? I argue that it's your professional duty. I use the scorpion and the frog parable. It's their nature to maximize profits. Your nature is to optimize for clients. This is a government sanctioned and regulated financial instrument. Everyone knows this information, at least on the inside. But your regulatory licensing obligation is to share it so consumers make informed decisions. But the first thing you have to know is, what is it? What does the playbook look like? Transparency for life insurance gives your clients tax advantages, and the government has provided these because it serves public interest. Your licensing assumes you'll share material information with your customers. The business reality, companies profit from client non-attention to optimization opportunities. Your job? Providing professional attention to clients' interests. Portfolio diversification. This is what skilled artisans know that others don't. Don't put all anti-selection advantages in one product. Term has conversion options. Universal life has cost disclosure transparency. Participating policies have something we call abeyancy rights. Strategic portfolio approach maximizes client information advantages across different scenarios. Here are some examples with a term conversion, best for health deterioration. We have 10, 20, 30-year windows we can spread policies across. UL cost disclosure reveals pricing inefficiencies, strategic premium timing. And then when we come to the participating product, we talk about abeyancy, strategic policy management, dividend timing. When you combine multiple product types, you create multiple opportunities for different life scenarios under all sorts of different anti-selection options for your clients. So here's what skilled advisors know. 4 key areas, maybe more. Wrapper changes everything. Anti-selection definition, professional duty to share, portfolio diversification. Bill Strain's principle applies. Results reflect artisan skill, not tool quality. Your expertise enables clients to access built-in advantages. This distinguishes skilled artisans from simple salespeople, and that's why we get together every week. Next Thursday, we'll explore another component of financial optimization. But today's question for the tribe: do you agree these are the essential topics for consumer education about anti-selection? Let's discuss. Once again, thanks for joining us. And as always, we'll see you here every week.